Welcome back to Synaptic Dividends. We break down a new dividend stock often to help you build your passive income portfolio. And hey, if that's your goal, you should probably be subscribed so you don't miss out. So today, we're going to dig into a real titan of industry, Emerson Electric.
Now, Emerson has raised its dividend for an incredible 68 consecutive years. That makes it a dividend king. That's about as elite as it gets. But the big question is this legacy a sign of just unbreakable strength? Or is that royal crown starting to slip a little? All right, let's jump into the numbers and see what's really going on.
Okay, first things first, we got to do a quick financial health check. I mean, the most important question for any of us income investors is pretty simple. Can the company actually afford the dividend it's paying out? Let's see how Emerson stacks up. And to answer that question, we're going to look at my absolute favorite metric, the free cash flow payout ratio. Just forget all those confusing accounting numbers. This tells us, in plain English, what percentage of the actual cold, hard cash a company generates is used to pay us, the shareholders. It is the purest measure of a dividend safety.
And Emerson's current ratio, it's sitting at just 41.2%. So here's the key takeaway. For every single dollar of real cash profit that the company brings in, it's only paying out about 41 cents in dividends. That leaves a massive cushion, making this dividend exceptionally safe and very, very well covered.
Now, hold on. You might have seen some crazy-looking number from 2023 that looked, well, terrifying. But that 438% figure was just a one-time thing. It was all because of some one-off costs as Emerson was transforming its business and selling off a major division. The fact that it snapped right back to 41.2%, well, that shows the company's true cash-generating power is incredibly strong. All right, so the dividend is safe. That's a huge checkmark right there. But, a safe dividend that never actually grows isn't all that exciting, is it? So for part 2 of our investigation, let's ask, is this dividend king still delivering real, meaningful raises for its shareholders?
And the history here is, well, it's nothing short of legendary. 68 straight years of dividend increases. Think about that. That means through multiple recessions, crazy market crashes, and all sorts of global events, Emerson has consistently raised its payout. This is a track record that very few companies in the entire world can even come close to matching.
But, and this is a big but, this is where the story gets a little more complicated. See, despite that incredible history, the recent growth has slowed to a crawl. The average dividend increase over the last 5 years has been just 1.4%. Now, this isn't some accident. It's actually a deliberate choice by management to pour that cash into buying new businesses and really reshaping the company for the future.
So, what do we have? We've got a super safe dividend, a legendary history, but really slow recent growth. That brings us to the final test, the ultimate stress test. How does this dividend hold up when the economy is in a total freefall? Because that's when you see what a company is really made of. And Emerson's resilience under pressure is just remarkable. I mean, look at this. In the depths of the 2008 financial crisis, right when other companies were panicking, slashing their payouts, Emerson gave its shareholders a massive 10% dividend hike. Then, during all the chaos and uncertainty of the 2020 pandemic, they still increased the dividend. This is all the proof you need that for Emerson, the dividend is a core, non-negotiable promise. Okay, we've looked at the safety, we've looked at the growth, and we've looked at how it performs in a crisis. We've seen the good and the slow. So let's put it all together and give Emerson's dividend a final report card.
The verdict is pretty clear-cut, honestly. First off, the dividend is exceptionally safe with that low 41% payout ratio. Huge checkmark. Then you've got the legendary history and the fact that it's proven to be completely crisis-proof. The one major trade-off, the one warning flag here, is that recent growth has been very, very slow while the company focuses on its transformation.
So that leaves us with the big question for you as an investor. Are you willing to accept that minimal growth in exchange for just ironclad safety and reliability? Now, if you want to go deeper and really understand the full business model behind these numbers, check out our long-form analyses on our main channel, Synaptic Investing. And of course, if you found this breakdown helpful, a like is always appreciated, and subscribe for more dividend analyses. Thanks for watching.